The imposition of tariffs between the United States and China, the world's two largest economies, has been one of the most significant trade policy shifts in recent history. Beginning in 2018, the U.S. implemented tariffs on hundreds of billions of dollars worth of Chinese goods, leading to a tit-for-tat trade war that altered global economic dynamics. The effects of these tariffs have been wide-ranging, influencing not only the U.S. and China but also the global economy. In this video, we'll examine the top 10 economic impacts of U.S. tariffs on China. 1. Increased costs for U.S. consumers. One of the most immediate effects of tariffs on Chinese goods has been the increased cost for U.S. consumers. As tariffs raised the price of imported goods such as electronics, clothing, and furniture, retailers were forced to pass these costs on to consumers. In many cases, products that were once affordable saw price hikes, disproportionately affecting lower and middle-income families. Consumer goods that rely on Chinese manufacturing have been particularly impacted, leading to inflationary pressures. 2. Disruption of supply chains. China is a major global manufacturing hub, and many U.S. companies depend on its goods for their supply chains. The tariffs led to significant disruptions as businesses were forced to adjust their sourcing strategies. U.S. companies had to either absorb the increased costs or find alternative suppliers, often in other countries such as Vietnam, Mexico, or India. While some businesses successfully shifted their supply chains, others faced delays and higher production costs, which hindered their ability to compete in both domestic and international markets. 3. Decline in U.S. China trade volume. The trade war and the tariffs have led to a sharp decline in trade between the U.S. and China. Bilateral trade fell as both countries imposed tariffs on each other's goods, reducing the flow of imports and exports. For example, U.S. agricultural exports to China, which were once a significant source of income for American farmers, dropped dramatically during the trade dispute. The reduction in trade volume also impacted industries such as electronics, automotive, and machinery, where tariffs made Chinese goods more expensive for American companies. 4. Shifts in global trade dynamics. The U.S.-China trade war has caused shifts in global trade patterns as businesses and countries sought alternatives to mitigate the impact of tariffs. China, seeking to reduce its reliance on U.S. exports, increased trade with other countries, especially in Asia and Europe. Meanwhile, the U.S. began forging new trade agreements and strengthening its economic ties with other countries like Japan, South Korea, and Mexico. This realignment of global trade flows has altered the competitive landscape, forcing companies worldwide to rethink their trade and supply chain strategies. 5. Impact on U.S. businesses dependent on China. U.S. companies that are heavily reliant on Chinese manufacturing and imports were hit hardest by the tariffs. For industries such as electronics, apparel, and consumer goods, which often rely on China for cost-effective production, the tariffs increased operational costs. Large companies like Apple, Nike, and Dell, which have significant manufacturing operations in China, were forced to reconsider their production strategies. Some companies sought to relocate production to other countries to avoid tariffs, while others faced slimmer profit margins as they absorbed higher costs. 6. Negative impact on global stock markets. The trade tensions between the U.S. and China contributed to increased volatility in global financial markets. Stock markets in both countries were significantly affected by the uncertainty surrounding tariffs and trade policy. For example, major indices like the Dow Jones and S&P 500 experienced fluctuations due to the evolving trade war and fears of a potential economic slowdown. The tariffs, coupled with economic uncertainty, dampened investor confidence and created an environment of market volatility, impacting global stock markets as well. 7. Economic slowdown in China. The Chinese economy was also significantly affected by the U.S. tariffs. China's export-driven economy, which relies heavily on international trade, took a hit as demand for Chinese goods from the U.S. decreased. In response, China's growth rate slowed, and some industries faced layoffs and reduced production. The tariffs negatively impacted China's manufacturing sector, which is a key pillar of its economy, and the Chinese government was forced to implement measures such as stimulus spending and interest rate cuts to counter the economic slowdown. 8. Increased costs for U.S. exporters to China. While U.S. companies were hurt by tariffs on Chinese imports, U.S. exporters were also affected by Chinese tariffs on American goods. The tariffs placed on U.S. products such as agricultural commodities, cars, and machinery made them more expensive for Chinese consumers and businesses. This led to a decrease in demand for American-made goods in China, further exacerbating the trade imbalance. Farmers, in particular, faced significant losses as China imposed tariffs on U.S. agricultural exports like soybeans, pork, and dairy products. 9. Effect on U.S. agriculture. The U.S. agricultural sector was one of the hardest hit by the trade war. China is a major buyer of U.S. agricultural products, but the tariffs led to a steep decline in U.S. exports to China. Farmers were forced to find new markets for their goods or face reduced profits. In response, the U.S. government implemented subsidy programs to assist farmers, but these measures were only temporary solutions. The long-term impact was a shift in the agricultural landscape, as U.S. farmers adapted to new trade realities. 10. Potential for future trade deals and economic cooperation. Despite the negative economic impacts, the U.S.-China tariff dispute also created the potential for future trade deals and economic cooperation. In 2020, both countries signed the Phase 1 trade deal, which aimed to reduce some tariffs and increase China's purchases of U.S. goods. Although the trade war did not fully resolve all issues, it laid the groundwork for future negotiations that could lead to more balanced trade terms and improved economic relations between the two countries. The agreement also indicated that tariffs could be reduced in the future if both parties continued to work toward mutual economic goals. The U.S.-China tariff war has had far-reaching economic impacts, not only on the two countries involved but also on global trade and industries worldwide. While the tariffs led to higher costs for consumers, disruptions in supply chains, and a decline in trade volumes, they also created opportunities for global trade realignment and the diversification of supply chains. The U.S. and China will likely continue to navigate their economic relationship, and the evolving tariff policies will remain an important factor in shaping the global economy. As trade negotiations continue, the long-term economic effects of these tariffs will depend on how both countries address their differences and find common ground to foster sustainable economic growth.